Hi, I'm Keith Weiner, CEO of Monetary Metals. Earlier this week I wrote an article called "What is Pushing Down the Price of Gold?" And I made a statement that turned out to be quite controversial. I said on Monday, we're seeing in the global bullion markets reduced demand for the physical metal. A lot of people called me and emailed me and said, Keith, wait a minute, in coin shops we're seeing a real shortage in gold and particularly silver in small retail size quantities like 1 ounce coins. And therefore the price should be a lot higher, or will soon be a lot higher. And so first of all, this is true. I do agree that there's this issue in coin shops. But I want to take a step back and I want to do a little bit of a deeper analysis than the superficial reading would come to this conclusion. First of all, let's introduce the concept of a proxy. A proxy is when you're trying to measure something that you can't necessarily measure directly, or it's difficult or intractable, so you measure something else instead on the theory that this is going to correlate very highly with this. So recently in the climate science community, there's been a lot of controversy about tree rings and ice core samples, and whether we can really know what the temperature was 10,000 years ago or 100,000 years ago by looking at some of these proxies. And it turns out that often proxies are not necessarily as accurate a predictor of the thing you're actually interested in, which is temperature, as they might seem. And so in this case, what we're really trying to use as a proxy is demand for silver coins, and trying to figure out the global demand for 1,000-ounce silver bars, which is the normal commercial unit that silver comes in. Is this really an accurate measure of that? And we're going to suggest not necessarily. So first of all, in the world of silver coins, in order to turn that bar into a coin requires a fairly heavy manufacturing process. That bar has to go through a succession of rollers under very, very high pressures to flatten it out into a sheet. The sheet then has to be stamped and polished, the edges have to be milled, you have to stamp the coin face on the coin and so forth. And so the point being that the manufacturing of these coins is highly inelastic. If a small increase in demand at the retail level occurs, there could be a true shortage of coins at the retail level that is not necessarily occurring in the global bullion market. And particularly right now, from all the indicators that we're seeing, industrial production is collapsing worldwide. They've had surprising downside numbers in Germany and in China and in the US and elsewhere. So demand for silver, which is used in virtually everything electronic, is probably falling, at least from the industrial side, and that doesn't necessarily match retail investor demand for silver coins, just as a point. The other topic that I want to cover, a concept I want to cover, is the concept of hedging. So a larger and a more sophisticated coin shop will hedge. When it buys, for every 5,000 eagles that it buys, it will short one future in COMEX. A future in COMEX is 5,000 ounces for the normal size future. And so why would it do this? It buys the physical metal, it shorts in COMEX. Why would it do this? And the answer is it doesn't want any exposure to the price. These dealers know, even if some of their retail customers may not be thinking about it, that the price can go up and down as well. And they don't want any exposure to that. They want to simply buy at X, which is obviously for a coin above spot. The dealer pays more than the spot price for that coin. They want to sell it at some markup above that. They want to make that spread, that's their profit. And they don't want to be speculators as to what happens to the price. They simply want spread only. But a lot of smaller coin shops, they either don't have the volume or don't have the sophistication, don't hedge. They buy their coins and then they go and sell the coins, and as long as the price is stable to rising, those dealers may successfully operate that business for years. But all of a sudden, if you have an event like what really began on last Friday through Monday where the price collapses, these dealers are faced with a dilemma. They may have bought this inventory at $28, $29, $30 an ounce, and now they're finding that market is $23, $24 an ounce, $25 an ounce for an eagle, something like that. What would you do if you had bought inventory at 29 and now the market price is 24 or 25? You're faced with losing money. And so a lot of these dealers are doing the only thing they can think of, which is they stop. And so here's a case where the superficial analysis might come to the conclusion that this is going to be reduced supply to the market, and therefore that would predict the price going up. that these dealers have X amount of inventory, they're not willing to deliver that inventory to customers, therefore that would increase the shortage and the price should go up. But let's suggest a different way of looking at this. Let's suggest that the relative amount of inventory that dealers hold is small relative to the flows. The dealer acts as a flow, a conduit between the global bullion markets, pulling silver, or in this case, through and delivering it to the consumers. If that dealer says, we are going to stop the flow right now, many of their customers either may not feel they have a choice, may not be that sophisticated, they may be loyal to that particular dealer. If the dealer says, we're not selling any silver today, a lot of those customers will go home unsatisfied. Their demand is still latent. They want to eventually get their silver, but they're not going to buy the silver today. And so what actually happens here is that this is not reduced supply occurring in the global bullion markets, but actually reduced demand. That all of these consumers that want to buy some eagles, or whatever their coin of choice may be, suddenly find that they're blocked, they can't access the market. And so there are many aspects of markets that are logical, but in this particular case, counterintuitive. And so our final ending note on this is, I think you should beware of superfluous analysis that may come to, superficial analysis that may come to the exact opposite conclusion of what is going on in reality.